Get started, everybody. Good afternoon, and thanks for joining us here today. My name's Kieran Leva. I'm a senior financial consultant here at Senecal Lyons and Associates Private Wealth Management. And thank you for attending the first part of our business owner educational tract. A little bit about ourselves before we get started. Our family office provides comprehensive and complete financial planning services to successful business owners and professionals, as well as to high net worth families with complex financial planning needs. The Business Owner Educational Tract is designed to provide important insights to help successful business owners and professionals understand and plan tax-effective and efficient strategies to retain and grow their wealth with their corporation. The first installment in today's presentation aims to highlight important aspects of business structures and corporate tax, with the aim of meeting your goals of growing, protecting, and transferring your wealth. On today's agenda, we will cover an overview of how to build wealth with your business through a corporation. Next, we'll dig deeper about the various tax rules and concepts surrounding corporations. And finally, we'll show how a good financial plan can be a benefit to you and your family. So a couple of notes before we begin. Our presentations are interactive, so we encourage you to use the Q&A button on your screen if you have any questions. We'll get to as many questions as we can at the end of the presentation. If we happen to run out of time and we can't get to all the questions, we'll be responding to the questions that are more general in nature and sharing them with all the webinar participants. If they're more specific, just kind of geared towards your specific circumstances, we'll respond to you separately. So finally, a bit of a disclaimer. The contents of today's presentation are meant to be conceptual in nature and should not be taken as specific advice because everyone's situation is different and unique. What may make sense for one situation may not make as much sense for another. Our goal is to introduce safe and tax-effective strategies to you, not necessarily to explain all the intricacies of the strategies here today. If you feel like you'd like to explore the ideas, we'd suggest getting together for a one-on-one meeting to review the details and see how it could be integrated into your financial plan. And this is, of course, of no cost, no obligation, all that fun stuff. So, next slide. Yep. So today we'll be focusing on specific aspects of a financial plan. However, financial plans are not prepared in a vacuum. Each element's success depends on the success of the other elements. So many investment advisors will only focus on how your portfolio is performing. And although we agree that portfolio performance and how your money is working for you is very important, it's only one component of your overall financial planning or financial well-being and of a comprehensive financial plan. For example, tax effectively coordinating your corporate and personal wealth and tax plan will consider the corporate structure, your family situation, your savings and risk management strategies, your retirement and business succession ambitions, and even your wishes to give back or leave a legacy. One of the core principles of our family office is that financial planning should be comprehensive and should consider the various relevant factors of your financial plan in conjunction with each other. As we work with our clients, we take the time to understand the variety of factors that will play a part in their financial plan, whether it's managing your cash flow, planning a major purchase like a home or a vacation property, preparing for the unexpected like death, disability, or illness, or planning for and transitioning into retirement. We work with our clients towards a cohesive plan that creates certainty in all areas of your financial future. You and what's important to you is really at the center of everything that we do. The inclusion of your family members in the planning process, if desired, can also be very helpful in creating a holistic financial plan. So on the screen, you should see some of the topics that we'll be reviewing today. We'll be highlighting the important aspects of these areas and keeping them at a high level, as each one of these could be an educational tract in their own right. So enough for me. Presenting the first installment of the Business Owner Educational Tract is Pierre Senecal, Executive Financial Consultant and Senior Partner at Senecal Lyons and Associates. A little bit about Pierre. Pierre has decades of experience as a business owner in the fields of manufacturing, land development, construction, international trade, and finance. Pierre specializes in providing advice on financial, corporate, tax, and estate matters to our clients. In addition to being a chartered professional accountant and a chartered investment manager, Pierre holds many industry-leading designations, including his CFP, or Certified Financial Planner designation, his Trust and Estate Practitioner designation, and his Chartered Life Underwriter designation, making him one of the top corporate planners in our industry. So without further ado, Pierre, please take it away.
In all kinds of situations, from startup to transition, and we found that each stage of their business life has different sets of complexities. What are the right decisions at the right time with the right partners you should be looking at? If you're starting your business, cash flow is usually king. It's a time when you're most vulnerable, and for a lot of you, incorporating may or may not be recommended, other than for creditor protection. This is especially true for sole practitioners, or if your business is not yet profitable. However, once your business is established and profitable, incorporating might be a very good solution, especially if you have partners. Shareholders need to agree on partnership aspects, who does what do you do in case of disputes, and family benefits and protection. So a lot more complexities come up here. You get to a point where your business is more mature, so day-to-day cash flow may not be as much as a concern as tax or business effectiveness and preparing for retirement and succession. Finally, in succession and transition, it's all about getting the most out of your business to secure your retirement and your legacy, and maybe even your business's continued success. So experience tells us that wealth creation for business owners comes from three main sources. Like most Canadians, business owners will personally invest through their home, real estate, TFSAs, RRSPs, and basically just build for their retirement there. However, we also find that because, and we'll talk about this later, because your tax rate inside your corporation is so low, it might make sense to keep your profits in your corporation and invest them through your corporation. That is the subject of another seminar. We'll be writing how to do that. But we find that the biggest part of value creation for most business owners is the value of their business. And for a lot of people who are able to sell their business, it's about getting the best value out of there to make sure they can retire comfortably. So why people incorporate? Well, historically, people incorporated for protection, right? They wanted to protect their shareholders from creditors, from different liabilities from the business, because the corporation is a separate body than you are. For many businesses, however, incorporating for creditor protection is not that effective. For example, if you borrow from the bank, they will ask for your personal guarantee. And many professionals, doctors, engineers, or whatever, they cannot hide behind a corporation, and they are personally liable for any professional acts they do through the corporation. So it's not perfect protection. So for most people, we find incorporation is mostly tax motivated. You see, with your corporation, you can defer taxes. That means that you're paying a lower rate of tax for your business, and then you can send the money to yourself through a dividend or other people in your family at a hopefully lower tax rate. So you can defer taxes, you can split with family members very often, and you can also income split with yourself over time. And finally, we find that selling your business, selling the shares of your business, could provide a very lucrative tax saving when you do that. So what actually provides value for your business? What makes your business valuable? We find that when people are at that stage of their business cycle, of their life, buyers like to see recurring and growing revenue in your corporation, something that's stable and predictable. They also like to see that you have many clients. They don't like it when you have a few big clients that could make or break your company. They like companies that are well known and visible. And they also like it when you have solid management and basically a succession plan that doesn't require you to be there anymore. One of the issues we often see when people are looking to sell their company rather, is that a lot of small businesses and personal businesses have a lot of transactions with related parties and shareholders or other companies, which often muddy the waters when you look at the financial statements. We work with our clients to make sure that in the years prior to the sale that your financial statements are cleaner and people can understand what they see. And finally, obviously, knowing something about your buyers always helps when you know what's motivating them. So if you're looking to sell your business, there are basically two main ways to sell your business. You can either sell sell your shares of your company, or the company could sell its assets to somebody who's not interested in owning your company per se. Now, owners, we find, like to sell shares. From a tax perspective, the shares, if they're taxable, the capital gains is only partially taxable, and they might have access to tax-free growth, the capital gains exemption. Purchasers, on the other hand, prefer to buy the assets because, first of all, they're not stuck with any hidden liability they can't figure out from your company, but also the amount they pay for the assets that you buy can be attributed to the assets themselves. So they're bumping up the value of what they're buying, and they can go through and depreciate it themselves and basically end up with tax deductions that they wouldn't have if they just buy the corporation. And basically, if they buy the corporation, they might be stuck with um, hidden tax issues that that are incorporated in there. So back to that capital gains exemption we just spoke about. Capital gains exemption means that if you sell the shares of your company, if your company qualifies and the shares qualify, your first $1.25 million of capital gains or profit on the sale of the shares of your company could be tax-free. And obviously, if you and your spouse own that or your kids, then you're just multiplying that, and you can end up with, $4 or $5 million of capital gains on the value of your shares that are not taxable. So very, very, very lucrative way to sell your business. Now let's look at, just so to give you an idea, when I talk about selling your shares versus selling your the assets of your company. So if for example, the company's worth $4 million, you've got equipment and goodwill and inventory, you sell that. If you sell the assets, the company might end up having taxable income from capital gains, recapture of amortization you took in the past, that is fully taxable. So in our example here, without getting lost in the weeds, if you were to sell the assets only, so the corporation's selling the assets, and then once they sold the assets, you take the money out of your corporation as a dividend to put it in your pockets, about 38 to 40% of the value of your company could end up being lost to tax. So that in our example here, $4 million, you end up with $2.5 million in your pocket. But if you sold the shares and you don't even qualify for the capital gains exemption, so you pay full tax on the capital gains, you'll end up with about $3 million in your pocket instead of 2.5. And if you can start multiplying capital gains exemption because your shares that you sold qualify, well, you could end up with, $3.5 to $4 million in your pocket at that time. So bottom line, in our example, with 2 times capital gains exemption, you end up with $3.5 million in your pocket, whereas you would have had $2.5 million if you just sold the assets. That $1 million difference here is what we call the negotiation zone, right? You might ask for more than 2.5, more than, for the asset sale, you only get 2.5 million, you get 3.5 for the shares. So if the client wants to buy assets or shares, you sort of would try and negotiate a higher price or something, depending on how you're doing it. Not all companies could be sold. I mean, if you're, for example, an engineer and you have your own company and everything's based on you, you won't be able to sell that business. So the whole capital gains exemption may not be something you're looking to do. However, you still want to protect yourself. So a lot of companies actually come to see us when they start as a client, and this is their structure. They own an operating company through a holding company. The business owner, the spouse, and maybe family members are shareholders of the holding company. And every once in a while, the profits from the operating company are sent tax-free to the holding company to protect the assets if somebody sues the operating company. And if the operating company needs cash, the holding company could lend the money to the operating company and get security over it. Again, you're not looking to sell the company, so you're not getting the capital gains exemption or anything, but at least you are protecting yourselves. But if people are looking to, at some point, probably sell their company or sell their business, then we often bring them through a process where they can change their corporate structure. We do that obviously in collaboration with their accountants and lawyers, but they end up with something that looks a bit more like this after we clean things up. So the operating company now belongs to the business owner directly and to a family trust very often, and the family trust has beneficiaries who happen to be the owner, the spouse, the children, maybe a holding company. And through this structure, if they do sell the shares of the company, the common shares that are sold and have a lot of the value are sold from the trust, and the trust can transfer or allocate that capital gains to spouses, to children, to whatever, and actually multiply. And that is at the discretion of the trustee, who often is the business owner. So good way to save taxes, protect yourself, and you pretty much check all the boxes here. A lot of questions clients ask us whether, how they should actually access their money or how they should pay themselves. So let's understand that if you have active business income, and in our example, $1,000 of profit here, if you pay yourself a salary with that, then it's tax deductible to the company. Company pays no tax on that. However, you get personal income of $1,000, and at the top rate in Ontario, there's just under $500 left for you to spend or invest. Whereas if you leave the money in the corporation, so the corporation now has to pay tax on that, but the tax rate is so low that you end up with just under $900 to invest. So your choice, invest 46.5 cents on the dollar or 87.8 cents on the dollar to invest or pay some of the expenses. So very often it makes sense to leave your profits, if you don't need them to live on, leave your profits in the corporation or in a holding company and protect them there. Another question we often get is, should I pay myself a dividend or a salary? Well, obviously, the higher your income or your profit, if you want, for the corporation that you want to send to yourself, the higher it is, the more it makes sense. It could make sense, rather, to pay dividends rather than salary. For example, at $225,000, if that's what you pay yourself, there's $150,000 left in your pocket if you pay dividends versus $142,000 for salary. So a difference of about $9,000. However, with dividends, you don't have to pay CPP costs, but on the other hand, you won't get it as a pension either later on, and nor do you accrue RSP room, so you can't really use that if you pay yourself a dividend. So every situation is different, and it demands an analysis and a discussion with our clients. But if you decide to invest the fund, should you leave it in the corporation to invest? Should you take the money out and just invest it, or maybe put it in an RSP? So in a situation where, for example, there's $25,000 a year of profit that you decide to invest every year for the next 15 years, and let's say you get 6% return on that, capital gains. And then after you retire, you keep the money invested the same way for another 25 years, but you take money, the same amount out every year for 25 years after you retire. We find that investing in one of those three vehicles, you're in the corporation, in an investment account, or an RSP, which is better, often depends on what your income will be in retirement. In any case, we find that if rather than investing through your RSP or your corporation versus just taking the money out, paying your tax, and investing it in an investment account, the investment account is the loser every time. However, comparing the corporate investment to the RSP, we find that the higher your salary, the more it makes sense to invest through your corporation. If you make about 60,000, that's sweet zone, you realize that it's not, you're indifferent whether you invest through your corporation or through your RSP, except the RSP obviously has limits. But the more money you'll make in retirement, the more it makes sense to invest through your corporation rather than through your RSPs. On the subject of RSPs and retirement saving and registered plans, another option that business owners have that could be interested is creating a defined benefit pension plan for yourself. Now, your typical civil servant defined benefit pension plan is not really accessible to small businesses. However, the government has created the individual pension plan, which in itself is sort of a defined benefit pension plans that's designed for executives or business owners. Although you could do it anytime you own a business, but if you're over 40 and you make over 100,000 a year, and especially if you've been in that business for a few years, it starts to make sense here. So you can do this to replace your RSPs or a defined benefit pension plan. Now, what are the pros and cons? Well, the benefits are you can invest more money through the IPP than you can through the RSP. And you can actually catch up. If you've been with the company for 10 years and you're 45 years old and you haven't contributed, well, you can actually top up your IPP with money that you haven't contributed in the past. And you can have a year of a huge investment inside your IPP that's just that much more money for your retirement. Again, it belongs to the company, but it's held in trust. It's protected. The profits from there are not corporate profits. So we haven't talked about this, but if you have too many investment profits, it does play around with your tax rate for the corporation. You lose some of that 12.2% tax rate. So investing in an individual pension plan actually makes you avoid that. Downsides to that, well, it's a bit more complex. You have to hire an actuary every 3 years to make sure you have enough money in there. Just as a comparison, knowing that your 2025 RSP contribution limit is going to be 32,000, call it 490. Depending on your age, this is the limit what you can contribute that year into your IPP. So instead of paying at age 55, 32,000 into your RSP maximum, well, you almost got 47,000 you can put into an IPP. Again, you don't get taxed on that. You only get taxed when you take the money out, just like a regular pension. And just before I pass this over, just final thoughts on estate planning issues. And we really delve into this into our estate planning seminar, but just so you know that if you own a company with assets and investments in there, by the time you and your spouse pass away, there could be up to 3 levels of taxation for that money owned in the corporation. First of all, the shares that you probably started your company off with $10 or $100 or something. And if your company is worth $4 million, when you die, the moment you die, you're deemed to have sold those shares. So there's close to $4 million in capital gains that you've got to pay tax on. So in our example, on the $4 million corporation, there's about $1 million worth of tax that the estate has to pay immediately. And obviously, if the heirs want to get their hands on the money, well, the corporation itself has to sell its investments, which might create a tax liability for the corporation. In our example, there's about $250,000 of taxes to be paid. And then that's all fine, but then you want to get the money out of the corporation into your heirs' pockets. Well, it can only come out through dividends, partially taxable, partially not. So call it another 1.3 million by the time the dust settles. So for the $4.25 million of investments in that corporation, about 2/3 of it goes to the government. And that's at a 50% tax inclusion rate. If the government gets its way and it's 67% inclusion, you're looking to get less than $1 million or a quarter of that money in your heir's pocket. So what do we do? Well, there are strategies that we recommend and implement with our clients before they die, and a few of them actually after they die to make sure that their estate can recover some of those taxes. So let's put this all together. Let's walk through a case study of business owners approaching retirement and see how a number of the strategies we've discussed can enhance wealth, allowing for more income security in retirement and maybe even enhance the estate for their heirs. James Lyons, a senior financial consultant and partner with Senecal Lyons and Associates, is a certified financial planner and a chartered investment manager. He'll lead us through an illustration of financial planning for business owners with a program that we work with that helps us illustrate all the ideas that we propose to our clients. So James, take it away.
Awesome. Well, thanks, Pierre. Good afternoon, everybody. Glad to be with you here today to share an example of the IG Living Plan in action and how the strategies that Pierre outlined can be evaluated as part of your specific circumstances. Just a quick reminder here that we are taking questions at the end. I know Pierre covered a lot of content. If anything's popped into your head, feel free to write in the questions throughout the presentation. Okay, so let's get into the IG Living Plan for business owners. The IG Living Plan is a dynamic database of your personal and financial circumstances, which we utilize to evaluate the impact of different financial planning strategies and how they'll have an impact on your ability to meet your financial goals. We utilize the Living Plan to analyze how different approaches may impact various factors of your financial plans. This could be the tax implications of different financial decisions. Pierre talked about corporate restructuring to access the capital gains exemption, implementing an IPP. All these various strategies we can evaluate and determine how it will affect your ability to fund your retirement successfully, leave the estate you wish for your family, or whatever your personal financial goals are. Our priority at Senecal Lyons and Associates is to gain an understanding of what's important to you first, analyze the different strategies that are available, and then implement the best strategies to accomplish those goals. Could I get a next slide, please? Okay, so let's flash forward now. We've worked together to understand your personal and financial circumstances as well as your various objectives. We've reviewed different strategies and agreed that strategy A is the correct way to proceed. Now what? Remember in school, it wasn't enough on the math test just to get the right answer? I can almost hear my math teacher from high school saying right now, show your work. This is where the IG Living Plan shines, as we can audit the strategies to ensure that they're successful in a variety of changing circumstances. Strategy A might be the correct way to proceed based on the current circumstances. But what if those circumstances change? And let's face it, they will change. Let's look at the last 5 years. I mean, COVID, the inflation crisis, interest rates surging, the current context of the Canada-US trade wars. Next week, there's going to be something else. Life is constantly changing, and we want the financial plans that we are implementing to be changing with the world. So using the IG Living Plan, we can audit and stress test the plan to collaboratively explore the what-if questions based on new goals, market shifts, or life changes. When one of our what-if situations shows an income shortfall, an estate shortfall, something of that nature, we can work together to decide which strategies to pursue proactively or which strategies might be available should something unexpected happen. The IG Living Plan allows us to test different financial planning scenarios to identify the ideal strategies and outcomes. We can evaluate personalized recommendations to further optimize your plan and adjust your plan to account for any life-changing events that might impact your future. Slide, please. So let's take a look at an example of the living plan in action here. So we've got a family, the Thomas family here. They've done a great job building a strong and growing business, while raising their family. Their children are still too young to know if they want to be involved in the business. And the plan right now is to sell their business in about 6 years. Their company has a diverse customer base, strong revenue growth, and is known for the quality of their product. And as a result, they've received a number of offers for their business. The Thomases and their accountants believe it's not unreasonable to assume that the value of the business will continue to grow over the next 6 years by a ratio of about 6% a year. But of course, like many business owners, they have a number of questions. How much value will they lose to tax when they sell the business, and what can be done to achieve a better outcome? Also, the profit that their business affords them a comfortable lifestyle that includes travel, private school for their kids, and they also have dreams of owning a second home in a warmer climate. The last few days in Canada would lead to that type of thing. But anyhow, assuming their business is worth $4 million when they sell, is their current lifestyle sustainable and their dream attainable? So let's take a look at their balance sheet and how things are currently represented for the Thomas family. Slide, please. Yes, thank you. So right now the business is generating a significant amount of after-tax income, which is after paying out a salary each year, a bonus. RSPs are maximized each year, and they have a monthly spend of about $15,000, not including taxes. You'll see that most of the wealth is tied up in the business here, and each of the spouses owns about half of the common shares of the holding company, which owns 100% of the common shares of the operating company. The excess cash flow from the business is not reinvested back into the operating company. It is paid as a tax-free intercorporate dividend to the holding company where it has been invested. The strategy has deferred the personal level of tax and protected these savings from creditors of the millworking business. So now that we've taken a look at the current balance sheet, when we work on an IG living plan, we start our process by not only reviewing the current situation, but as part of the planning process, we would discuss with our clients their tolerance for risk, expectations regarding investment returns, inflation, life expectancy, any pertinent factors that may have an impact on your plans. And these discussions would then form the basis of the assumptions used in our plans. So at first look, everything for the Thomases looks fine with no additional strategies implemented. They can maintain their lifestyle in retirement, purchase their vacation property, and leave a sizable legacy for their children. But again, I can hear my math teacher right now. Show your work. So what if the situation changes? And again, the situation will change. How does that impact the success of your plan? So for example, we know that in real life, annual investment returns vary from year to year. Some years they'll be higher and other years lower. When we're accumulating assets, so in the income earning years of our lives, the average return over an accumulation period of 25 or 30 years is all that matters. However, in retirement, when capital is now being spent rather than saved, the timing of returns can have a profound effect on your financial plans. Good returns in the early years can provide significant financial cushion and produce a large estate, whereas poor returns in the early years can put the ability of your plan to sustain your lifestyle or leave an estate at all at risk. So to have confidence that our goals can be achieved, we need to stress test our plan. And with the IG living plan, we can run a wide range of what-if scenarios to test the impact of the plan. So in this situation in particular, we've crash tested the plan to say what if, well, crash tested was apropos there. The market crashes by 30% 1 year after retirement. For the duration of retirement, inflation is higher by 0.5 percentage point. Our long-term investment return rate is 1% less than expected, and the Thomases live for 5 years longer than expected. So until age of 95 with disappointing returns. So you'll see on the graph there that towards the end, we have the red bars popping up, which is indicating that we have a shortfall for their retirement once all of these what-if situations are accounted for here. And that's about a 10-year gap in their retirement plans here. So we're going to take a look at a few different strategies, the first of which is reorganizing to access the capital gains exemption. Without going into too many details here, Frank and Isabel have created an attractive business, making a share sale a probable event. Working with us and our tax experts, we've identified that the current business structure will not maximize their potential tax savings on a future sale. So working alongside our team here and their accounting and legal advisors, we are going to work to reorganize their business structure, amalgamate the holding company and the operating company, and freeze the amalgamated corporations in favor of a family trust. And by carrying out these steps, all the shares in the business will be held either directly or through a family trust, making use of the capital gains exemption a possibility. This new structure would also provide the possibility of multiplying the capital gains exemption by using the capital gains exemption available to their children, and would also allow for dividends to be paid through the trust to a new holding company that is a beneficiary of the trust, protecting these future savings from growth. A little bit of a technical detail here, but to access the capital gains exemption, the amalgamated company would need to be purified, of the passive investments that were built up in the original holding company. There's about $800,000 there, so we would need to clean that up a little bit. There's a variety of strategies for carrying this out, including payment of a safe income dividends to the new holding company or past services contributions to an IPP, which we'll take a look at as we go through the strategies here. So Frank and Isabel have been working in their business for about 30 years here. And as Pierre mentioned, as a result, they would be in a position to establish an IPP. So for their remaining working years, the 6 years until they sell their business, that would allow for higher tax deductible contributions to an IPP than could be made to an RRSP. So you get more space to save some tax dollars there. It would also allow for their company to make a large retroactive tax deductible contribution to the IPP for past service. And although there's other options that we discussed earlier, what we're going to do here is that the value accumulated with the IPP is going to be used to acquire a life annuity that will provide guaranteed income for life of about $150,000 a year. Slide, please. So in addition to implementing the individual pension plan, we are also going to recommend that the clients delay their Canada pension plan. You may be aware that you could take CPP as early as 60, but also delay it until 70, and there's various pros and cons to doing that based on different circumstances. But by delaying until age 70, this will significantly increase the value of their Canada pension plan payments, which combined with the income security of the individual pension plan is really going to provide them a lot of income security in retirement, which brings up an interesting change in their strategy here. Because the IPP will provide guaranteed income alongside the Canada pension plan getting delayed, Frank and Isabel are now a little bit more comfortable taking risk with their investments because they have more assurances that their lifestyle will be maintained through the guaranteed income that they've put in place. So they can take a more aggressive approach to their investments, which will have a few benefits. First and foremost, over the long term, they'll have a higher expected rate of return by taking on more risk. There will be more volatility in the investments, but of course they have more income security at this stage to insulate against any volatility in the investment markets. Also, by having an investment portfolio that's geared towards dividends and capital gains, which are more tax efficient than interest income, they'll reduce the annual tax impact on their investment income. So through this shift in their approach to investments combined with the IPP and delaying Canada pension here, not only would we predict a slight increase in the investment return, but we'll also see that this will help reduce any grind on the small business deduction by reducing passive income. So essentially with the capital gains exemption, the IPP annuity, delayed CPP, portfolio shift, all of these various situations that we've implemented here, you'll see that the plan is now looking quite a bit better and they can maintain their retirement, purchase their property, leave a large estate, and this will persist through all of those various what-if factors that we evaluated before. Slide, please. So again, let's review the planning so far. So we talked about accessing the capital gains exemption to significantly improve the financial cushion that they have. We're providing guaranteed income for life and eliminating any concern about loss of lifestyle or outliving their money because of the IPP and the capital gains exemption. However, the added income security from the IPP does come with a cost in the sense that it will reduce the net estate, which you'll see point 2 on the slide there. The net estate that the clients are achieving here with the capital gains exemption and the IPP and delayed CPP is actually less than some of the other options here, which is, again, why we take a approach of evaluating all the options, show our work, understand how the different implications of different strategies will not only affect the ability to achieve the overall goal, but how strategies implemented in conjunction with each other can have an impact on that overall goal. So again, kind of coming back to some of the strategies that have been implemented here, with the confidence gained from the IPP, the income sustainability of the annuity, as well as the delayed CPP, taking on more risk in the investment portfolio will allow us to have more tax efficient portfolio, but also have a higher investment return on the non-registered investments. If we were to look at some further strategies here, we could evaluate things like the use of permanent life insurance. So using some corporate-owned investments to fund a permanent life insurance policy over 20 years, which you'll see adds another, $250,000, $300,000 to the estate value. But also within this insurance policy, the cash value within the policy could be access to enhanced retirement if desired, through some type of policy loan, taking dividends as cash. There's a variety of strategies to access some of the equity in that policy. The insurance, however, would produce a more dramatic increase in estate values if they were to die earlier than assumed in the plan. Of course, we're assuming that they live to age 95, but if they were to die early for any particular reason, the insurance would add some value to the plan if they were to pass away earlier. So again, just taking a look at how all of these strategies work one by one and in conjunction with each other, it's clear that combining several strategies in the context of a highly individualized IG living plan can have a profound effect on your confidence that your spending goals will be met, how much is left over, what spending will be done, and what taxes are paid. And through the practice of evaluating all these different strategies, just by, again, not making any change to their operations of business, their profits, their revenues, anything like that, just by reorganizing, implementing some strategies on our end here, the net estate has grown by 50% compared to if none of these strategies have been implemented, which has added a lot of income security for life. So we'll just slide forward here. And again, I will encourage you to share questions. We're just going to be gathering them shortly here. And Pierre, I'll bring you back on in a minute here. But while we're kind of gathering the questions that have come in here, I just wanted to take a quick second, if you'll indulge us, to introduce our team. Thank you. So we've had Pierre Kieran on here today. You also see the rest of our client servicing team as part of Seneca Alliance as associate, as well as some of our head office specialists that we have on retainer to help us with any complicated situations. Slide, please. At Seneca Alliance and Associates, we focus on keeping our clients at the center of everything we do, which of course requires some collaboration, not only with our clients, but also with their trusted advisors, whether that's an accountant, their lawyer, all of the above, business partner, so on and so forth. We're not looking to replace anybody or step on anybody's toes. The way we like to work is that we work in conjunction with our clients, their already trusted advisors, as well as our in-house experts, whether that's our regional specialists who provide support in different areas, or our advanced financial planning experts who are on retainer at our head office for corporate tax law, estate law, reviewing different strategies for us. At Seneca Alliance and Associates, again, we like to keep our clients at the middle of everything we do and work in conjunction with them, their advisors, and our trusted team of experts to provide the best service possible. Slide, please. When you retain Seneca Alliance and Associates as your financial planning advisors, what you will also have access to is the private company advisory team through the IG Private Wealth Management brand. So we have the IG Private Company Advisory here, which is essentially in place for our business owner clients. Will have access to these advisory service when they are considering raising capital, the sale of their business. They can coordinate with our team of experts to figure out the best way to structure things to achieve the desired results. At IG, we have a commitment to providing services at the highest level, keeping you informed of how things are updating, providing confidence, and delivering excellent service. And again, harkening back to show your work. We're not providing a financial plan and then once it's on paper, that's it, that's all. We are constantly reevaluating, adapting, and making sure that you're in a position to feel empowered about the impact that your financial plan will have and your ability to achieve those financial plans. Slide, please. Just a quick comment on IG as a company. We're coming up on our 100-year anniversary of providing financial planning services in Canada. We're one of the biggest wealth managers in the country. There's about $120 billion in assets under administration right now. And through Investors Group, IG Private Wealth Management, we have access to world-leading asset management expertise and exclusive managed investment solutions through some of our preferred investment partners, who you'll see on our next slide here. We're uniquely positioned in Canada. IGM is part of the Power Corporation of Canada. You'll see some of our sister companies there, Rockefeller, Wealthsimple, Mackenzie, all of the above. We've also partnered with world-class partners for investments, insurance, banking. You'll see we've got BlackRock, JP Morgan, Franklin Templeton, Manulife. IG has taken the approach of partnering with the best in the business to ensure that we have not only the people on the ground here to provide services, but also partners that can provide products that are required in specific circumstances. So I'm just going to gather some of the questions here. While I gather the questions, just like to invite you to review our upcoming schedules of webinars. We like to do these every month or so to focus on different topics that may or may not apply to your personal circumstances. If you just want to gather some knowledge, hear from the experts, share with, your friends, family, business partners, what have you. We like to put these on for informative purposes on a regular basis here. Alrighty, well, thank you all for joining us. I have a couple of questions here, Pierre, if I can just get you to jump back on for a second. So my favorite question. How are you compensated for your services?
Oh, that's a good one. We are a family office, and the way we get paid, our clients never get a bill or an invoice for the services that we offer. Some of them need huge planning efforts, some less, some need corporate restructuring, some don't. But at the end of the day, the way we get paid is like any other investment advisor that we are also, is we get paid I guess a very competitive fee on the assets that we manage. So for example, if you have over $1 million of investments through us, you pay 0.9% a year for the management of those assets. And basically that pays for everything that you could receive from us, any other type of advice or planning services.
Awesome. That's great, Pierre. Thank you for that. I do have a couple of questions that have come in that are a little bit more personal and intricate, so we will respond to those offline. And again, if anything's popped up after reviewing the presentation, please feel free to get in touch with us, and we'd be happy to review your questions on a one-on-one basis here. With that, that will be the end of our presentation. So thank you all for joining today. Hope you found the content informative.